Hello, everyone, and welcome to today's webinar, Autocallable ETFs, a new frontier in global public markets. Thank you for taking the time to join us. We are delighted to be joined today by 4 experts across ETF issuers, investment banks, and wealth management firms. My name is Summer Wang. I'm the Americas reporter for SRP, covering structured products based in London. Before we begin, and here are a few quick housekeeping items. This webinar is being recorded and will be shared with registered attendees after the event. We encourage you to submit questions throughout the session using the chat box on your screen. We'll try to take them as they come in. The webinar is expected to last about 1 hour. So today's webinar will focus on autocallable ETFs, the latest major innovation in the structured products world. To be specific, we'll be focusing on the autocallable ETF using swap contracts to access autocallable exposure. We'll explore the different uses of underlying assets and payoffs, complexity versus transparency, tax treatment, risk and portfolio management, as well as the implications on the structured notes market. I'm going to spend the first 5 minutes providing an overview of this segment before we move into the panel discussion. To put the timeline into perspective, coincidentally, it was exactly a year ago that Calamos brought the first of these products to market, CAIE, C-A-I-E, which I'm sure many are already familiar with. Then innovator ETFs and true shares came in the second half of the year. But it's worth noting that in the US market, there were a handful of interval funds physically invested in autocallable structure notes, as well as ETFs using option contracts for the autocallable exposure. We'll touch on those briefly when discussing the use of swaps. So over the last year, a total of 21 autocallable ETFs have been launched by 8 asset managers in the US. Although these funds all use swaps with significant variation in the strategies employed in terms of underlying assets and payoff structure. I've also been tracking and covering SEC filings for upcoming autocallable ETFs. The trend is clear. We can expect to see more products and more providers entering the space this year and next year. So first of all, I'd like to take a step back and draw everyone's attention to the US structured notes market. As many of you know, the rise of autocallable ETFs is closely tied to the well-established autocallable structured notes market. That's why we're seeing an increasing number of autocallable features being incorporated in ETFs. The first slide gives us a quick idea about how big is the US structured notes market and its continuing growth. I'd like to note that the sales are 100% actual based on SRP data and does not include callable fixed rate notes. The market is poised to deliver another record year, as we can see from the slide, because the sales for the first 5 months this year has already reached 50% of last year's 55%. Autocallable structures account for around half of the sales over the last 2.5 years. Then let's turn to autocallable ETFs. The first autocallable ETF, Calamos CAIE, has just hit $1 billion in less than 12 months, while ACEI, run by First Trust and Vest Financial, is already nearing 800 million in assets since February. Today, we are lucky to have gathered the top 2 providers in this webinar, Calamos and Vest. So the chart groups granting shares 8 autocallable ETFs into one category, but we'll be able to share more details about this single stock underlying ETFs in the next slide. This table, compiled and provided by Calamos, gives us a straightforward glance at how the autocallable ETF space has evolved over the last 12 months and their various strategies. QIS, or quantitative investment strategy, is another key area we'll be exploring today, alongside newer features like maturity buffer, snowball, adaptive vault control, and stability features. The underlying exposure covers various QIS indices, index basket, a group of individual stocks characterized as diversified on the slide, as well as single stocks / single security. Worst off refers to the single worst performing asset in a basket. So these ETFs are all income oriented except the Calamos Autocallable Growth ETF. By dividend indicative yield, we can see the single stock ETFs really stand out, offering over 20%. With that overview complete, let's turn to our panel. I'd like to invite each panelist to introduce themselves and tell us more about their involvement within the autocallable ETF space. So why don't we start with Dolapo?
Hi, my name is Delapo, and I lead our private investor product group here at Goldman Sachs. We provide the financial advisor and financial intermediary community with a broad range of solutions across derivative products. Now, historically, this has mostly been structured notes, where we are the leading issuer on the street by market share. But more recently, we have been providing derivative payoffs via swaps to, often tied to an index to the ETF community. Now, I do want to be clear that our role is different than a traditional ETF issuer or an ETF provider in that we do not promote or sponsor the ETFs and are therefore here in an educational rather than a fiduciary capacity. We have been swap provider though for a few years now, actually, and that's both for some traditional, more options rating strategies, like some of the offerings from ProShares, as well as the more recent auto-callable ETFs, like the Vegas Shares auto-callable income ETF.
Thanks, Dolapo. Matt?
All right. Thanks, Summer. Appreciate it. Thanks for the time, everybody. Matt Kaufman. I'm the global head of ETFs at Calamos. I've been in the ETF space for about 23 years. Started my career at PowerShares. We built out the first options-based ETF there. From there, went to an actuarial firm, Milliman, where we were doing a lot of institutional balance sheet hedging, volatility-controlled strategies as well. We built the intellectual property for the first buffered ETFs in the market about 10 years ago. And, fast forward to today, we're looking at auto call structures. We were able to bring the first auto callable ETF last June, just crossed over $1 billion in assets and seeing a lot of activity in that space. So we're excited to talk about it.
Thanks, Matt. Rishi?
Thank you, Summer. I am a senior vice president at West Financial, and together with our partners at First Trust, we have a suite of over 100 ETFs in the target outcome and target income space. And in that suite of products, we are happy to now add autocallables ETFs as well into the space. We can talk a lot more as we proceed in. As background, I have a structuring background at a couple of banks in New York. And then, as a team, we are focused on structuring new payoffs for investors.
Thanks, Rishi. And lastly, we have Ken.
Hello. Thanks, Summer. My name is Ken Nuttall. I'm an advisor and chief investment officer for Black Diamond Wealth. We're a registered investment advisor based in New York City here. I actually sit in Pennsylvania here. But we are active users in both structured notes and these income note ETFs here. So, we have taken a lot of thoughts on where to use each of the individual products. So as we get further into this conversation, hopefully we can add some value there.
Thanks, Ken. So guys, why don't we start with, talking about the past 12 months. So Matt, Calamos was the first one bringing this autocallable ETF. Were you surprised with what had happened afterwards? And what are your key observations?
I don't think we were necessarily surprised, knowing the options space in the ETF market. If you look at the covered call space, it's now a $300 billion space. Derivative income is a very large part of the ETF market. It's an equally large part of the structured note marketplace as well. So, going back 10 years ago, the buffered space was very popular in that zero rate environment. Bringing that into the ETF world worked very well. So the auto call space, is a very large segment of the structured note market. So we spent a couple of years mapping out the way to deliver that into the ETF market. There's a number of different ways to deliver auto callable exposure. I'm sure we'll, get into that. You can do single stocks, you can do worst of baskets, you can do vol control and synthetic dividend. And so there's a few different ways to deliver that. Our goal and the premise that we started with was how do we deliver high, stable, and tax efficient income through the ETF wrapper using an auto call strategy. So going through that landed us on the version that we brought to market last June with CAIE, CAIE, as about a 14% coupon. And it's worked. Like, I think that's the conclusion is these auto-callable products have delivered, not just ours, everybody on screen here, but it delivered on what we've said we were going to do, where you can get 31, 32 cents a share every single month that's tied to the equity markets as long as they don't fall below specific barriers. So, a little over $1 billion in that product. We've got a NASDAQ version as well. We launched auto-callable growth notes, or the snowball version, with Cage. I've got about half my own retirement in that, just giving amplified long-term growth over time. So that is the premise for bringing the auto call space into the market. And you've seen, a lot of people come into the market after with their own versions. So we're excited to unpack all of that.
Mhm. Yeah, Rishi, tell us a bit more about your collaboration with First Trust and what products you have launched so far.
Uh, Thank you. Yes, like we've been in the ETF space together since 2019. And as I was mentioning earlier, over 100 ETFs, and well north of, 45 billion in AUM across our target outcome and income products. And similar to what Matt was saying, like we've seen the space evolve over the last 8 years in particular, as especially as target outcome started sort of changing the space here. And like we had, for example, filed our version over a year and a half ago, actually, as the first one in the space. So yeah, we've been thinking about this, but trying to find the right um, you know way and the right infrastructure, the framework to have the product out in the market. But yeah, we see, like in the structured note space as having existed for several decades. There is familiarity space, and there is a natural use case here. And we can unpack more as in terms of why the particular type of products that we've started with. But we see that there is a lot of investor adoption and growth across new segments of the market where structured notes have not accessed as well. So a lot more to talk about.
Sure. Yeah. So because Vest has a fairly different strategy from Calamos, and one used QRS, the other used worst off. Yeah, we'll talk a bit more about that. Yeah, but Rishi, I do want to have your view in terms of the use of autocallable ETFs versus covered call and buffer ETFs, because you guys have a very established lineup of buffered ETFs.
Yes, yeah. So that's actually a very interesting way, especially how we view the covered call space as well. For us, uh, our core suite is target outcome and target income products, and the fit was how investors and financial advisors could use products in portfolios to improve the outcomes, what used to be, say, a 60-40 portfolio as example. So the autocall products are conditional income in our so it fits into that suite, and how it diversifies something like a target income, which is more guaranteed, and guarantee is the wrong word to use, but it's more consistent and stable, as opposed to conditional income in the space, but with a higher average coupon level that you would see.
Sure. Let's focus on QIS. So this is a question for you, Dolapo. If I ask you, explain what is a QIS and how is it used in ETF format?
Yes, of course. So, generally, it's a broad category, but the acronym itself stands for quantitative investment strategies. And, it's a fairly large umbrella of offerings that has existed for several years. And it's existed across a number of wrappers, including traditional structured notes, a number of insurance products, and then, yes, some of the swaps and some of these indices that ETF issuers are now including in their payoffs. And at their core, what they're meant to do is replicate a traditional, more systematic trading strategy that somebody might employ. And so, more legacy indices might more or less just track a static basket of assets, whereas a quantitative investment strategy would usually involve an index that tracks not just a set of assets, but a set of rules around allocation and rebalancing to those assets. And the broad idea of it is that, most people have started to look at, investing as much as a science as an art, and you'd want something that has a rules-based, trigger-based, signal-based investing approach compared to something that might exercise more discretion. And that was sort of the reason that these indices became popular. Additionally, because you can set a number of rules inside of those indices, you can control for a specific number of market scenarios that you want to adjust to and that you want to respond to. And as a result, for products like structured notes, that became something where it was pretty attractive as a complement to more traditional investing strategies. Now, as far as how we think about these when it comes to our relationship with ETF issuers, we are an investment bank with broad trading capabilities. And every day when it comes to the structured notes market, we receive demand for traditional investments, like people who want exposure to the S&P 500, broad-based ETFs, other indices, individual names. But then we also have people who come to us who want us to provide exposure to something that is more systematic, that has a little bit more of, rules-based flavor to it. And we have strong capabilities of both. And in many cases, the clients that we engage with, they have offerings that cover both segments, both quantitative and non-quantitative investment strategies. And, I think as far as the overall investment thesis goes, the reason that some people, might choose one or the other is that some of our clients prefer to keep things, strategies very simple. They want them to be, basic, highly replicable, and we're happy to accommodate that. And others are looking to do things that might require more infrastructure and scale, potentially with greater cost efficiency. And, I think that that's where, banks can sometimes provide a bit of value given their trading capabilities that they've invested in over the years. Now, many of these swaps right now, especially, are not just quantitative in nature. They're also built in with a laddering feature, which is, I'm sure, something that people will touch on, throughout this webinar. And I think that one of the value adds of that structure in an index is that it replicates something that people do manually, which is, ladder auto calls, roll auto calls, manage their entry and exit. And you can include that as one of your investing rules in the index. So, that's something that I think that we're going to continue to see a lot more of from the demand side. And as a result, you'll see more banks able to accommodate them as well.
Mhm. Thank you, Matt. So as we mentioned, it is the first swap-based autocallable ETF in the market, and you guys just went with the QIS strategy, something that was brand new back then. Yeah. So what was the consideration behind this approach? And as the market evolved, we've also started to see like non-laddered structure. Perhaps you can give us an idea about this.
Yeah, I appreciate that. As we looked at the auto call space and wanted to bring the first one to market, we looked at worst of, we looked at single stock, we looked at the number of QIS strategies. We landed on partnering with an investment bank, an equity derivatives desk, JP Morgan, and Mercube as the index provider, because for us, it served the purpose of delivering high, stable, and tax efficient income. Being able to do this in an index form, laddering it together, and then trading that on swap gives us a remarkable ability to generate high and stable income. And then the features of the index, say the QIS components, actually serve a very good and some might say cool purpose. If you just do the simple approach, sometimes that can expose you to additional risks. If you are able to stabilize some of the parameters that otherwise might put you at risk, like volatility control or stabilizing dividends, well, now that can aid to stabilize the income that we are able to deliver to clients through this ETF. So there was a very clear purpose and reason for doing this and using a volatility control and a synthetic dividend. Those are two very popular auto call features around the world. If you went to Europe during COVID, where a lot of companies failed to pay their dividends, it put a lot of banks at risk and on the hook for those dividend payments. And so you can use tools like synthetic dividends or decrements in order to stabilize a lot of those parameters. They actually work together to give you a very reliable experience. If you add a decrement to an index, it's going to reduce your index performance, your reference index performance, but it actually lowers the forward price of the option that you're using, and that increases the coupon. And so if you can increase the coupon that you can capture, what we have found is we can look historically, and that actually has increased your performance for the TAIE benchmark by about 3% per year and by about 6% per year for the NASDAQ strategy. So the vol target, the decrement all work together to deliver a really high, stable, and tax efficient income. We were hearing from advisors as well, like Ken, that were using auto-callable yield notes. A lot of times they would get called away, as the name would imply. They would have to go find a new note in the marketplace. And a lot of the worst ofs or single stocks, they leverage market volatility in order to collect an income. Well, if we can stabilize that volatility, we can now give you an ETF that ladders the performance together. And every week when a new note is going into the ladder, the volatility is the same, so the income is the same. So that's why we did it that way.
Yeah, thanks. We'll be talking more about the risks around volatility control indices as well as the complexity around it. Yeah, but before we do that, Rishi, so as I mentioned, so FTVest has got two existing autocallable ETFs in the market. Both are tracking worst of index baskets. Yeah, so I want to know, why did you go with that approach? And you must have thought about QRS strategies as well, right?
Yes, indeed. And this is where there are parts of our approach that may conflict a bit with what Matt was talking about. So as you know, autocalls as an investment payoff has been in the market for decades now, right? And we've launched with the worst off. These are classic autocallables, right? The large part of the market's already familiar with it. It's been used for decades. And we believe that in contrast to the quantitative driven payoffs, there are a lot more nuances there, which investors are not ready for yet and have to discover. That risk is not appreciated yet. And hence, we believe that the right place to start was here. And that's how we've, it's basically a laddered basket of vanilla worst of autocallables. So from an investment perspective and advisor use case, like over 80% of the whatever 50 billion of issuance last year was West of autocallables, right? And this has been the trend. The QI size is much smaller part of the structured note market. But yeah, and we do believe that at some point, we might also be there, but it's with certainty. Again, we're kind of front running that, but yeah, as we get there, we can talk about it. But that's sort of the background to why we believe like the worst of products are the right place to start, but with best execution. So you can talk a little bit more about that. I don't know if that.
And I'm very glad we have Ken here today, who's bought both ETFs from Calamos as well as FTVest. Yeah, so Ken, tell us a bit more about Black Diamond and your portfolio, and how did you get into autocallable ETFs?
Yeah, so we've been over here. We've been running portfolios of structured notes for a long time since we kind of started. My previous life, I used to support the structured note desk at JP Morgan, so I'm very well versed in how this works. We have a whole process here where we go out and we will buy structured notes and put them into our clients' portfolios. The problems with that is that sometimes it's a little manual. It's very very cumbersome at times. You have to buy in $1,000 increments. If you had to try to sell these things, notes are not exactly the most liquid things in the world. For it, kind of the benefits of using the ETF is that you have the liquidity and you have some of those operational benefits of, hey, I can put this into a client's account who has less than $1,000 to invest into a structured note, and they're pretty consistent incomes. The other thing with structured notes is that as the markets go up and down, volatility goes up and down, you can get better terms on certain notes at certain periods and worse terms at other periods, and we kind of looked at these and we like the structures of how these are structured, going out, having multiple of it, and instead of having one particular note, you have 52 or more possible outcomes here. You get a little bit more consistent outcome, easier to trade. Going back to the QIS versus worst of, kind of the idea there is we've used both of them. The QIS is, a little bit more to get my head around, trying to understand what it is, how that volatility control works, what it does. Worst of, we've been doing that for years, a little bit simpler, a little bit, more understanding of what it is and what the map is behind it. Hey, if the S&P is the worst of and it goes down more than 35%, all right, we're going to lose money. It's on the QISs. It's a lot more map or, type thing, which, people don't necessarily understand, appreciate. I don't know what the proper word is, but, if both these products, I think are going to, serve their purposes very well. And we're using both of them for our needs over here.
Thanks, Ken. I'd like to talk a bit more around QIS, but mainly about how volatility target indices work. So because I've also got feedback around, so first, so maybe this is a question for Matt. So because all your strategies so far, you have the sole counterparty of JP Morgan. So do you see the single counterparty as a risk? And also there is like discussion around the use of leverage. So just to give the audience a brief idea, leverage is used to achieve the bull target, so amplifying the gains in stable markets, but risking greater losses during like sudden downturns. It's usually capped, but some is as high as 500%. So what do these indices, how do they deal with the severe equity sell-off? So mainly, Matt, what's your thought on this counterparty as well as market downturn?
Yeah, thanks, Summer. Maybe we'll start again with the framework that the goal is to deliver high, stable, and tax-efficient income. In order to do that, you stabilize the volatility, in this case of the S&P 500 for Chi and of the NASDAQ 100 for Chi-Q. So we stabilize that around a 35% weekly implied volatility target. So if S&P 500 vol is, let's say 15, 20%, you're going to have increased exposure to the S&P 500 for that week in order to get to your 35 volatility target. That is reset in our product every Friday at 2:00. JP Morgan hedges their balance sheets every Friday at 2:00. Our notes roll every Friday at 2:00. So the reason that we do it this way is to create what I would call as a frictionless experience. This makes its way through the bid-ask spread of the ETF. It's also a very core reason to why you would want to work with a single counterparty like JP Morgan. The counterparty risk is not like we might have thought of 20 years ago, prior to the financial crisis or during the crisis where you had some banks that may have gone under and had a difficult time paying out on their notes. We have solved for that via the collateralized swap structure. So, let's take the worst case scenario. If JP Morgan goes under, I think we'd all be in, a world of hurt. But in that case, you will have a product that looks a lot like a treasury instrument. All of your collateral is sitting at State Street. The custodian does not sit at the bank, at the counterparty. If you are, I don't want to make Rishi's case for him, but if you are in a worst of basket, well, you do not have stable vol. You have stochastic vol. So you are going to want different quotes from different dealers. That's my own opinion. And so for us working with JP Morgan, we have an unbreakable swap contract with them where they have to be there at all times. And so there really is no counterparty risk to the strategy like we might otherwise think. And there really is no benefit to having multiple counterparties bid for that because all of the terms are stable and identical. If you were doing a worst of basket, I would want to know what other banks could offer. I'd want to know what Goldman can give me or, what RBC can give me because they have their own stochastic vol models. And then if you look historically, which is one thing that we are able to do, we can tell you exactly how many coupons you lost. We can tell you exactly how much principal preservation you had. So if you take our Chi-Q strategy and look at the benchmark, similar to Goldman's strategy, I can tell you that you would have gotten 97% of your coupons and you would have had 0% principal impairment. If you take an 18-month or a 24-month worst of basket, you can look historically and you can say, okay, the Russell would have fallen by, 30, 35%. At times it falls by that much a lot. And so if you model that historically, there's times where you could have lost half of your principal. And so there's give ups there's trade-offs, but I think it's important that we know what those trade-offs are and be able to look historically. So if you're looking at a QIS strategy, I would ask the issuer for the back test. Ask them how many times you got your coupon, what percentage was that paid, what was the drawdown. You should ask that of your worst of strategies. Anybody that's doing an auto call should be able to tell you what the principal at risk was going back, 20 years or so.
Yeah, so I do want to add a note that in terms of the QIS strategies, yeah, so currently in the market, for example, in the table we've seen, like with the true shares, yeah, so that QIS strategies doesn't seem to be like very much tied with one investment bank or hedge provider. Yeah, we're starting to see like a bit more filings using similar strategy. For example, the Schroders upcoming one. Yeah, so in that case, it's not necessarily. Yeah, so the index, for example, is only owned by S&P instead of by a particular investment bank.
There's three parts of the triangle. There's the ETF issuer, there's the index provider, or in the case if you don't have a laddered index, you're trading OTC swaps, just a number of them, and then you have the bank that you're trading with. So S&P is the index provider for some. You've got Mercube for us, and then you've got Goldman as a bank. Morgan Stanley's working with True Shares. So what you're seeing is this unlock around the world where the ETF channel is now a distribution channel for equity derivatives desks. And I think that is what we're ultimately seeing, through the launch of the Autocall Fund, is that we can now take structured note strategies and bring them into the ETF wrapper, where you're now adding transparency and liquidity and ease of operational efficiency for guys like Ken. And so that is what we are seeing, and that's why the proliferation is so predominant, because every bank around the world now wants to bring their structured note strategies into the ETF wrapper, rightfully so. And ETF issuers are now able to deliver this exposure in an efficient way that they couldn't get otherwise.
Yeah, and we're starting to see questions coming in. It seems like people really want to know more around counterparty risk and QIS. So I'll take the two questions at the same time. Yeah, so one is there a worry that in the chase of AUM, firms are launching over-engineered strategies which are overfitted? For example, high vol targets, high synthetic dividends, and multi-stock, etc. A bit similar in QIS. And the second question is, can you clarify comments on no counterparty risk? Would issuer default be a different outcome versus credit risk in a structured note? So maybe you start, Matt, and then we'll pass it to Dolapo.
Oh, appreciate that. Yeah, I've talked a lot, so I'll talk quickly and then I'll pass it off. Yeah, so we've eliminated the counterparty credit risk because this is a fully collateralized swap. And so, we have a backup swap counterparty if JP Morgan goes under, but they are required to be there to make a market in the swap. And then we have about 95% of our assets sitting in risk-free collateral, treasury bills, box spreads, which allow us to earn a little more than risk-free rate. And then JP Morgan posts variation margin for that swap as well. So fully collateralized swap that eliminates the counterparty credit risk. And then as far as over engineering, I've been in the insurance and actuarial consulting space and ETF space for more than 20 years. If you buy a fixed indexed annuity or those types of products, they have volatility controls in them. We've been doing vol control on the balance sheets of global life insurance carriers for 20, 30 years. The folks using volatility controls survived the GFC, and a few of them that did not survive. And so vol control has been around for a very long time. We've been doing it for multiple decades. I can tell you that there's no overfitting being done there. It's, how can we give you the most reliable coupon possible without breaching those barriers? And so that's how we built our strategies. The other way would be to use maybe a worst of basket or a single stock basket, in which case, the risk there is that you've got the Russell 2000 or whatever you're tied to, maybe it's SpaceX, that's falling, more than the barrier. And if your tenor is too short, if you're not going out 3 to 5 years, you're putting portfolios at risk of being below that barrier. But again, you should be able to look historically and know what you're in for before you buy it.
Dolapo?
Yeah, of course. I'll, just to add on to both of those points, I guess I'll go in the same order that Matt did. But, to start with the counterparty risk piece, I think that's one of those things where people need to decide sort of how best to quantify them. I mean, these are swaps, and as Matt mentioned, that generally requires the posting of collateral. And it's for the investor, it's for all the participants to understand what might happen in the event that some of the counterparties were unable to provide the swap exposure that they're contracted to provide. But as far as people asking about the counterparty risk versus a traditional structured note, it does behave differently. You think about a swap is generally a more evergreen type of instrument, especially when it's used in the context of an ETF. So that exists forever, but there's margin. On the flip side, you've got your traditional autocallable note or your traditional, debt security that's issued by a bank, right? And that's a debt security of the bank, like a bond. That tends to have a fixed maturity, a fixed date at which you'll get back your cash. So while your default scenario there is that the issuer, is insolvent or is unable to continue operations, and then you have a sort of '08 like scenario where you need to collect from the issuer, you end up essentially in the capital stack like a bondholder that is for a fixed term. And additionally, that is something that is compensated for. And so, for many people who are familiar with buying structured notes, when you look at the credit stack of the different issuers, you can imply their funding appetite, because of the fact that they are issuing bonds. And depending on your perspective, that might be something to monetize or not monetize. So I think, like most things, it depends on the risk tolerance and the risk understanding. And that goes, to Matt's point additionally on the QIS indices. So I think that any investment strategy can't be universally just viewed as positive or negative. Different ones operate well in certain environments, others operate well in other environments. And as far as, over engineering or not, I do think that sometimes complexity exists for the sake of complexity, but sometimes complexity also exists to do something that would be very difficult to do manually. And that's true across the investing world. So not unlike a vanilla strategy, you can have a poorly executed vanilla strategy. You can have a well-executed complex strategy. You can have a poorly executed complex strategy and a well-executed vanilla strategy. I think that what matters probably more so than whether or not it's systematic or not is whether or not the investor, or whether or not whoever's evaluating the investment has confidence in whoever's selecting that strategy, whoever's designing that strategy, and whoever's providing the exposure from that strategy. And just lastly on costs, I think similarly, you can get inexpensive QIS strategies, you can get expensive vanilla strategies. You can get expensive QIS strategies and inexpensive vanilla strategies. I think that it depends on the firm that is selecting these strategies, how they do them, whether or not you do them in an auction or whether or not you do them from a single individual. That doesn't necessarily determine the price, just that who you're getting the price from. But I'll stop there.
Yeah, so very quickly, Dolapo, can you give us an idea, what's Goldman's general risk management approach to QIS versus non-QIS? And is it necessary or common to have a backup counterparty?
Yeah, of course. So I will say, from the, Goldman being a single bank, I won't speak too much about the value of a backup counterparty or not, but, I think in some cases that does exist because people like the idea of at least having a, break glass, if needed option. But as far as how we do the risk management, so I think part of the reason that you're seeing the acceleration in this space be pretty rapid is the fact that it does leverage a lot of tools that banks have built over the last couple of decades. So many of the models, many of the risk management practices, many of the hedging practices, especially when it comes to things like volatility, dividends, interest rates, that infrastructure has been built. And in many cases, it has been used already for the structured note space as well as the annuity space. And so a lot of it is quite portable, especially when you talk about autocallables specifically, which are probably one of the best, if not the single best understood product in the structured note space. And banks, they tend to operate in a way where your goal is to properly hedge all of the risks that are created, whether it's your swap or whether it's your traditional auto call. So, as Matt was mentioning, that might be at a specific interval, that might be at a specific time, but generally banks seek to be completely flat on their exposure, if at all possible. And the idea is that as market conditions change, banks hedge dynamically. And so, the capabilities of the bank to respond to different market environments, to hedge in different market environments might affect the performance of certain products, whether they be swaps or autocallables, but quite a lot of that return is contractual. So the liability of hedging usually sits on the bank's balance sheet rather than, something that's borne by the investor.
And the role of backup, yeah. Matt?
I think that's an important point because a lot of advisors and investors will ask, like, who's taking the other side? If you're getting 14% income, someone else is losing 14% income. Like, that is not how it works. Like a bank like Goldman Sachs, their goal is to just hedge out their exposure, and they can hedge out their exposure using S&P or NASDAQ futures. And so that's another point of the QIS type of version. But Rishi's familiar with some of this as well, so I don't want to take all the time.
If I may
Sure.
add the point there, Summer, on
Mhm.
the swap side.
Yeah.
So yeah, there is, as folks here was mentioning, that there's a target audience for each of these payoffs. Like Ken had initially mentioned as well, and eventually, like both would coexist as it is right now as well. But in terms of execution and swap structure, there are certain aspects that, at least from our side at West, we like focus on or you think are very relevant aspects. So one is best execution. So any like these are when you do a swap on a payoff like this, right? You need to hedge the risk, right? And in competition, there's always price discovery that happens. Right now, in the absence of competition, that how do you explain the best fill, right? Like there has to be some edge that either in the index or you're so it's harder to tell whether the fill is best anyway. So we believe that there have to be multiple banks in competition in order to, even for an index structure. So as we consider sort of version 2
Mhm.
of where the index should come out, we
Sure.
believe that's a question that should be asked in terms of what does competition among banks bring to pricing for any payoff.
Mhm.
I think the
Yeah,
way that
thanks,
you
Rishi.
explain the best execution and the best price is if you have an index, then you have a third party delivering the price of that index. And then the market maker and the bank and the issuer can all trade to that price. And so you end up having the exact same price because you have a third party index. But if you go worst of, I actually agree with Rishi here, where you would want best execution. You would want multiple counterparties bidding because they all have their own ball surfaces, they have their own pricing. And so that gives you an opportunity to get the highest coupon from my worst of basket because I'm having multiple banks issue. But if you have a third party index, everybody's looking at the exact same price. And so there is really no best X on that. But I don't know if you have a response to that. That's how I see it.
Yeah, actually, so on that, as we are looking at the same question, like if the index level is the bogey that the bank has to hedge, and you put that in competition, you'd actually get better than index or a higher coupon than what's actually in the index.
Sure.
So if the index is fixing the coupon, you should be doing, like in competition, you would see like index minus 50 bips or index minus 1%. So sort of fun bet. So anyway, yeah, that's the analysis and argument in terms of the fit.
Yeah, that makes sense.
Yeah, thanks both. Rishi, I want to stay with you a bit. We're still getting questions around QIS, but Rishi, I think it'll be helpful for you to give us a bit more idea about how this kind of convergence you've seen from structured notes to ETFs. Because for the two existing strategies you've launched, you also have a few more that have been filed with the SEC, and we're starting to see, like, for example, snowball, as well as maturity buffer, and even stability notes coming to this space. Yeah. So what's your take on this?
Yeah, I mean, we definitely see the space evolving into a suite of payoffs, just like what the structured note space has evolved over the past few decades. And what comes first or second, will change based on issuer. But yes, there is a place. Overall, when you look at even the note space, there's income and there's based payoffs. And within income, as folks were mentioning, it's the worst of the single index or single stock version or QIS versions, right? And similarly on the growth, the underlier were different, but you can either have like snowball as a way for memory effect to come in, or a way of this at catapult is another word for it that's coming out soon as well. So there are a few different you know, ways in which this is coming. But as a space, we believe that the ETF wrapper changes things quite dramatically because of how it sits in an investor portfolio in the US. Yeah, so structured notes, because of the credit risk, like you pay the entire notional at dollar value cash up front in order to buy the note, and you're fully exposed to credit risk, right? So Matt was mentioning this as well. In the ETF framework, that core value is held in collateralized like treasuries as an example, right? The swaps are separately collateralized for their market. So it's a very different from a credit risk perspective, and so the way it sits in investor portfolios, there are the advised part, the fee-based part of portfolios where structured notes could not typically make their way into. Into the majority of that side, ETFs and funds have access to them. So we believe, just like what happened in target outcome, the buffer payoffs existed in notes decades before the first ETFs came out, 2019. But the the size of that market has just grown, both with education. So that's one big focus from our side, like our very large sales team and experienced sales team of the First Trust side and West is focused on. But with education, we believe the industry over here with these payoffs will grow. It's not cannibalizing in the long run. Just what happened in that out.
Yeah, so this is something we want to expand as well. And one of the questions touched on it. Do you expect to see more flow of ideas from notes to ETFs? Yeah, so this question is specific to US. Maybe broadly, let's talk about the implications when we see such a growth in autocallable ETF space. How would they impact, or how are they impacting the structured notes and structured notes SMA market? Let's start with Ken, because Ken, you're experienced in running structured notes SMA portfolios.
Yeah. I mean, I know, autocallables are mainly an income type product, but the other side that's out there is growth stuff, right? Like I've made the argument, like sometimes we'd actually use structured notes. We call them better ETFs, like, hey, you're going to buy SPY, or you can buy an ETF that gets you leverage of 1.5 times SPY with a 20% buffer or something like that for 5 years, whatever it is. That, in my opinion, it's a little bit of a better ETF structure, especially if you have someone who's going to put into like an IRA or retirement space. I'm waiting for the next generation here to come out for these growth notes where you get some version thereof, let the smart guys figure out how to actually build that and make it work well in an ETF. But, that's where I think you're going to see the next explosion in this. And autocallables, again, they're just income products, like, hey, you got someone who's in retirement and needs some good retirement, and it's well structured and well thought of. This is, the right place to do it.
Okay, you think, is there anything like the autocallable ETF industry, mainly the distributors or ETF providers, can do to help raise the awareness for the buy side or better serve the buy side?
Yeah, I mean, one of the struggles that you'll see in this market is just education and people understanding what they are and getting their heads around what it is, especially if you use kind of the QIS stuff. Like, all right, I know when Kai came out, I had to sort of sit down and figure it out, what it was. And I've been exposed to this world for a while. That's gonna be the hard part. The other thing to be worried about is, like, sometimes people just buy this because it's got the highest yield and not exactly understand what they're owning underneath it. Now, where again, the education comes in saying, hey, hey, this thing's paying this great yield, but hey, if X, Y, and Z happens, it could not work so well. So education is definitely going to be the calling card on this.
Dolapo, do you have a thought on this? And also in terms of the ideas that you see coming from notes to ETF, or perhaps from the portfolio perspective to the ETF, because recently, like you've had a mandate with Vega shares for the adaptive vol control, right? That's something that was new to the market.
I'll take those in order. I will start by saying, and I think the group has been getting towards this, but the idea that these offerings across wrappers can coexist, I think, is a very powerful one, and I think it has a lot of basis in fact. Many of the clients that we are engaging are not looking at these as single deployment solutions. like small point of order. I think like it was mentioned something about, fee-based accounts versus commissionable accounts. I think all of the products that exist today, or most of the products that exist today, are actually flexible enough that, we actually have, billions of dollars that we'll distribute to advisors, and I'm sure Ken can back me up here, that will put these into wrap fee accounts. So, the economics and the operations of that are already like, I think like, pretty well fleshed out. That said, there are real tangible differences between, say, something where you manage or customize an individual offering versus something that is a little bit more of an evergreen product that you might be allocating to periodically, but is broader, like broader in its use cases, or at least broader in like the number of times you can use it. And so, whether it's scale versus differentiation, I think those are real things for people to evaluate. But most people end up needing multiple solutions for multiple client scenarios and multiple market environments. Now, I do think as far as the idea flow goes, like anything else, innovation is born by the fact that, people are sharing ideas, they're seeing ideas, they're testing new ideas in different wrappers. And so, yes, I'd say, you mentioned this adaptive volatility. We've spent a lot of time on volatility control broadly. That's more of a catch-all term than an actual like single way of doing things. And so, yes, you could have a fixed volatility where you adjust the leverage in order to, target a specific volatility. And even within that category, there's different ways of evaluating what volatility you look at. And some of these might seem like small differences, but, they might add a few basis points there, subtract a few basis points there. Over time, that might really change, the return profile of one strategy of another. And that's existed in the structured note space. One thing that, yes, we've been asked to show exposure on, and I'm sure others have been as well, as, more adaptive volatilities, where the volatility target is, like a methodical, it is formulaic, but the target itself adjusts to market conditions. So maybe if volatility is lower, the volatility target itself might be lower, but still above the current volatility. And if the volatility target is, or if volatility is higher, the volatility target itself might be higher. The reason you might want to do something like that is that a strategy like that might permit you to use less leverage than, say, a fixed volatility target where you have to hit a certain number in every sort of market condition. But like anything else, there's potential trade-offs there, right? Some people do want more leverage, depending on the market scenario. And, that might be able to help, provide a higher yield in some environments versus others, whereas others might want to have less leverage in the event that you then have a drawdown coming up, particularly in a higher volatility environment that might come up after. But I think that like all of these, the point on education is paramount, because until somebody understands the strategy, it's very difficult to understand where it might fit in the portfolio. But I think there's a lot more coming on that. This is, good example, this webinar right now. I'm sure all of the conversations that will follow.
Thanks, Dolabo. So one of the questions is asking you guys to make an elevator pitch for 30 seconds, which I'm not going to ask. However, I'm sure if you did, it would definitely cover tax treatment, right? So this is something like ETF providers, have been talking about for years. So perhaps we can start with Matt. Tell us about the general tax treatment, and is there anything Calamos has done differently to improve the tax treatment?
Sure. So we built the first auto-callable fund. So I would like to hope that we set the standard there. ETFs are tax efficient. Like that is how investors have come to know ETFs, especially equity-based ETFs. So if you're delivering equity-linked income, we would expect nothing less than to be tax efficient from the ETF. So the income that we are distributed, that is flowing through the laddered index that we have. So there is no actual income being distributed from any instrument that would need to be treated as ordinary income. And so we are able to distribute 14 or around 18% for KaiQ, and that just reduces your cost basis over time. It is tax deferred income, and then it will be treated as long-term capital gains when you sell if you've held for longer than 1 year. We have some of our collateral in treasury bills. That's a requirement. And so you'll have a little bit of OID from the T-bills, but a large majority of the income you're receiving is going to be tax deferred and then treated as ordinary income. We have some advisors that, their clients don't need 14%. I use my parents as an example a lot. They're 80 years old and they spend about 5% of their portfolio every year. So they'll take their 5% from Kai, reinvest the difference, and that will create a cost basis that will, in theory, outlast them. And then we'll bequest those shares to my siblings who will get a step up in the basis. So an interesting way to largely create tax-free income for somebody maybe in a later retirement stage. But that is how we have built all of our auto-callable products. The Snowball product, Cage, delivers amplified growth over time, historically about 2.5 times the S&P going back over the last 20 years. And that is all just compounded growth. We don't actually have to distribute those coupons to you. We just store them and grow them inside the fund with a memory feature. And so that is tax deferred growth. That is, again, long-term cap gains when you sell.
Yeah, because more recently you've set up this C-Box box spread ETF, and we're starting to see the fund flowing from
Yeah.
Kai to C-Box. Is that to
Yeah,
do with tax?
C-Box. We hold a lot of box spreads as collateral. That's a way for us to earn a little bit even more than the risk-free rate. Long box spreads. C-Box is an ETF we built largely for us because it makes our collateral management very efficient. So we charge 74 basis points for our auto call ETFs. We pay 10 basis points to JP for the swap, and then we earn about 30 to 40 basis points over risk-free on our collateral. And so that, creates a net expense, a net cost of about 40 to 45 basis points for investors. So we do everything we can to keep efficiency in taxes. The C-Box product does not distribute, just grows by about 40 basis points over risk-free. You can use that on your own if you have cash on the sidelines or, want a T-bill alternative. It just grows tax deferred. And there's no distributions. It's 14 basis points. We do not pass that fee on inside of our ETFs. It's just a free exposure. But we use that for our collateral on a lot of our auto call products.
Rishi, would you like to chip in? Anything done differently as that?
Sure. Yeah. I mean, the tax treatment in the ETF space, it's also it is evolving. Surprisingly, we would expect tax laws have been sort of static for a while, but as the industry is evolving, consensus among tax council, etc., have also been evolving. So there is some conservative views on how these should be treated, and but as the industry sort of, there is some products that lead the way. There's this opinion that's evolving, but that said, yeah, I mean, so for us on ACY and ACYS at least, the laddered portfolios of diversified or stock baskets, the treatment actually similar to what structured note would see. They are income right now is what we have, and but there are scenarios because we have 40 Act structures that some part of that distribution could be classified in a lot of different ways, including return on capital, depending on sort of time of purchase and how the fund is seeing inflows and outflows.
Thanks, Richie. I'm conscious of time, yeah, but there one question about that are opportunities beyond the US. Yeah, so as we all know here, so Carmos has launched a UT Autocallable ETF in Europe across multiple exchanges. Yeah, and perhaps you could tell us a bit about that. And in terms of the opportunities you've seen in Europe, or things that are working differently from the States. And also, Dolapo, I want to hear from you as well in terms of, you must have got queries, from international players or other markets, right? So perhaps Matt?
Yeah, this is a global effort. I think all three of the providers here with First Trust, Goldman, have presences that go well beyond the United States. So we have launched a version of Kai. The ticker Cake, CAKE, was available. So I thought that was an interesting one to throw out there. But that's available in UCITS form, so you can get that throughout Europe and Latin America, anywhere that the UCITS product is available. The model for financial advisory overseas is a little bit different than it is in the United States. But it's probably for a separate webinar. If we build an ETF in the States, we're automatically registered in all 50. We can sell after 75 days. You go over to Europe and you've got country registrations and distribution things to consider. But yeah, I think the short version here is that the auto call space is multiples of that in Europe as it is in the United States. We've been over there over the last few weeks. talking to folks, and it is very clear, as we expected, they understand autocalls and they need ETF education. The opposite is here in the United States, where people understand ETFs and they need to know autocalls. And so that is the framework that we're taking. But I would expect this to grow on a massive scale globally as structured note strategies make their way into the fund wrapper.
Yeah, I'll echo Matt where I would say that, in terms of being approached by firms that are looking to either take something that they're doing in the US and bring it to another jurisdiction, or essentially launch a global offering where they work with banks to provide, the hedges. We're seeing quite a lot of that. And that's because of the fact that, yes, the auto-callable payoff itself is a global payoff. It's something that exists, across jurisdictions. And, maybe more elementally, part of the reason that I think a lot of us or all of us are on the Zoom is that over the last 20 years, the you know ability to generate yield by selling volatility on broad-based indices, regardless of your wrapper, has been a very persuasive one. So the question always becomes, what is the best way to deliver that exposure? What's the most efficient way to deliver that exposure? But none of those are limited to the US. And so, as sort of income replacements or bond alternatives, I think you're going to continue to see innovation in this space in different jurisdictions, and that includes, then different considerations around currencies and target yields and other regulatory regimes and things like that. But I think that's exactly right. Autocallables are a global phenomenon, so you probably wouldn't expect this to stop soon.
Thanks, Dolabo. I want to wrap up this webinar with a final question. Everybody would be wondering what's next, given all the activities with them, but where is the next innovation? What would it be? So, Rishi, do you have a thought on this?
Yeah, I mean, as we were mentioning, not just in terms of novelty that hasn't been seen before, but there's just so much more that has to be ported over into the ETF space for the full benefit of this wrapper and the liquidity and transparency that the ETFs provide. Take benefit, like just from underliers perspective, there are many others, even in the US as well as international, that are still pending. There's some payoff types, again, because there are different user bases now. So, but yeah, this product set is going to diversify pretty soon in the next 1 to 3 years.
Anyone wants to comment on it?
When we built the buffered IP about a decade ago, very few ETF folks knew what a buffer was, and that took a lot of education by a number of groups. I think we're innovating and trying to innovate at a pace that investors and advisors can consume information at. So we taught people what a buffer was, and then you move into floors, and then maybe enhanced products, and now we're moving into the auto call. And so teaching folks what an auto callable structure is, for somebody who's used to using ETFs, that is a brand new term. And so you can anchor, depending on where they're coming from, you can anchor in maybe options or covered calls, liking it to a long dated put right strategy. Calamos is the largest converts manager in the country, so we think of it like a reverse convertible, and that makes sense to us. Others might think of it like a basket of bonds that are tied to the equity markets. So depending on who we're meeting with, we want to bring people along and bring them up the curve on where the space is going, because it actually can help people. It can help create really high, stable, reliable income, contingent income. And for those who are looking for income outside of traditional sources, it's a remarkable opportunity once you get your head around it. And I hope we do this in 10 years and everybody knows auto calls and we're talking about something different, and I think it's just going to keep evolving. That's how things tend to go.
Yeah, then we're running out of time. I think that's a great place to finish. I'm aware that there are so many other questions we didn't get time to address. I want to thank you, everyone. So you can find all the panelists on their LinkedIn, and we've tagged them all on SRP LinkedIn page. And I'll see, if it would be helpful if we compile all these questions, and perhaps there could be more discussion on it. Yeah, so thank you again for sharing your expertise, everyone. And if you have further questions, please contact the Pablo contact, whose email is on the screen. Yeah, you're going to see it shortly. Here we go. Yeah, so thank you very much for spending your time with us today, and enjoy the rest of your day. I'll see you next time.